Assalamu alaikum friends, welcome to March-June 2021 SBR question paper. So this is question number 1 for 30 marks. As you can see on your screen, let me zoom out this for you. So this is about a group accounting because question 1 is group accounting. Okay. So Columbia Company is a parent of a listed group which operates within the telecommunication industry. During the year ended 31st December 2005, Columbia acquired a new subsidiary and made adjustments to its pension scheme. So that means we have pension scheme as well here, which is your IAS 19. Okay, and we have the exhibits. So the first exhibit is regarding the acquisition of the subsidiary. Second is about the net assets, also the valuation of the assets, and the third one is regarding the pension scheme. So now, before we go to the case study, let us first go through the requirements. Draft an explanatory note to the directors of Columbia addresses the following issue. First, whether Columbia should be considered the acquirer in a business combination. Second, a calculation of goodwill. Okay, you definitely will have something to do with goodwill. Either goodwill is there, you have to correct it. Either you have to calculate goodwill. So goodwill calculation you must know, guys. Okay, calculation of goodwill at 1st of July 2005, explaining how fair values of both the consideration and the net assets have been determined. Okay, and coming to the last, how the defined benefit and defined contribution pension scheme. There are two types of pensions. One is defined benefit, the other one is defined contribution. They should be accounted for in the year ended 31st December 2005. Right? Before I go to the case study, let me tell you one thing, especially the first one. Consider who should be the acquirer. I have very recently covered a video on business combination IFRS 3, where we had to go through certain steps. What are they? Number one is you have to identify who is the acquirer. Then you have to identify the acquisition date. But in the past papers, you have never seen a question which says that you have to consider who is the acquirer. Usually they tell that he is the one who is acquiring this company. So we know the parent, we know the subsidiary, right? This is a unique type of question that came from March-June 2021. So guys, every year you will be expecting something unique, something that has never been there in the past paper. That's why it's important that you should know each and every aspect of your textbook. Of all the standards you should know. It does not matter whether it comes in the past papers or not, because what it will come, something or the other will come for your exam, which has not been asked in the past paper. I'm not saying all the questions will be different, but at least one or two you will get a different question that has never been come. But we know, because we have went through IFRS 3, if you are very good in IFRS 3, okay, here you need to apply the IFRS 3 rule. If you have business combination, if you are good in the standard, you should know how to know who is the acquirer, because I've done this. In IFRS 3, I've covered this part. Also, the second part is also I have covered how to calculate the fair value of consideration as well as the net asset. This also I have covered in IFRS 3. This one was regarding IAS 19, right? This also I have covered. So I've covered all those videos. If you have watched my videos closely, if you are very good in standard, you should not have a problem here. But now let us read the scenario. So let's see how many exhibits. We have 3 exhibits, okay? Exhibit 1, accusation of payroll company. So Brazil company is a competitor of Colombia company. On 1st of July 2005, both Brazil and Colombia acquired 50%. They both acquired 50% of the 5 million ordinary one shares of Payro. So the consideration paid by the Colombia consisted of a cash of 8 per share. What is the consideration? That is in cash, okay? From Colombia. That is 8 per share, and also 1 for 20 share exchange. When the market price of Colombia share was 10 each. Brazil also paid 8 per share for their interest but did not issue any shares to the original shareholders of Payro. Okay? The ordinary shares of Payro have 1 voting right each. Following the accusation, Colombia had the contractual right to 60% of the vote of Payro, with the remaining 40% appointed by the Brazil. Okay? So they had tried to appoint 60% and remaining 40 is by the Brazil company. Okay. Brazil also has voting rights, veto rights over any amendments to the Articles of Incorporation and also over the appointment of the auditors. Veto means it's a major decision, okay? That means he has the power to change the decision entirely. That's the meaning of veto. If he says yes, it's a yes, and if he says no, it's a no. Okay. Brazil company and Colombia each appointed one member to Peru's senior management team. So both of them had appointed one member. It is the senior management. It is the senior manager appointed by Colombia who makes the key decisions. Senior manager is appointed by Colombia who makes the key decisions regarding the development of Peru's new technologies, its principles, revenue stream, the markets that it will operate in, how it is financed. So what are those decisions? What is the principal revenue stream, which market they are going to operate, and how it is going to finance. The senior management appointed by Colombia also provides a supervisory role and has the right to request the significant activities gets board approval such as imposing restrictions on Peru from undertaking activities that will significantly increase the credit risk. Okay, so here they have given you two companies. One is Brazil, one is Colombia. They have given you the facts also. They have given you that this one has this voting power, this has this voting right, this has this major decisions to make. All those things is given for you to decide which one, Brazil or Colombia, is the parent of Peru. Coming to second. Okay. Just okay. The net assets of Peru reported in the individual financial statements. Individual financial statements had a carrying amount of 32 million. And however, on the accusation of Peru, the directors of Colombia discovered the following. Okay. So it looks like that Colombia, if you see here, you must be very smart. If you go to the second exhibit also, you come to know that the accusation, the directors of this one discovered the following. What does it mean? What does it mean? It means parent is the Colombia company. Okay? Not Brazil. Even looking at the facts and all, you should be able to know that Colombia is the parent company. Is the acquirer. But you should write these things in words. On 1st of January 2005, Peru acquired 6 million 6% coupon bonds for 6 million in an unquoted company. In which company? Unquoted company at par. Bond interest is paid annually on 31st December due to a premium on the redemption. So there's a premium on the redemption of the effective rate of interest of was 8%. The premium is 8%. Pero has a business model to collect the contractual cash flows from the bonds and therefore measures them at amortized cost. So this is relating to what they're using IFRS 9. IFRS 9, okay? Because the business model is to collect cash from the bond and therefore measure them at amortized cost. It's to collect the cash flow. It's not to sell that bond. It's to keep that bond till the redemption date. So they measure it at amortized cost. Colombia holds similar unquoted assets, but has a business model whereby they may enter, collect the contractual cash flow or sell the asset. So their business model is different. They buy sell the asset also. Bonds with a similar risk profile for a similar quoted company were trading at 2 per bond. A discount of 30% is considered reasonable to reflect the differences in liquidity in both those types of bond. Now, one of the identifiable intangible assets of Pero at acquisition was a brand. This is an intangible asset, okay? The brand had a carrying amount of 4 million. Colombia had a similar branded product and therefore planning to discontinue the trade of Pero's branded product with immediate effect. Because they had a similar, so they don't want to continue with the Pero's brand. The future cash flow from the Pero's product post-acquisition are therefore considered to be nil. If the trade of the branded product were to be sold to a competitor in order to continue the trade, it is estimated that it would be sold for around 5 million. The brand, okay? Pero has several technical support service contracts for which there are outstanding performance obligations. Included in contract liability are deferred, okay? Included in at this date is a balance of 2.8 million. In respect of those contracts, it is estimated that this contracts will cost. So it is the contract cost 1.7 million for Pero and any other market participants to complete. A markup of 30% is considered reasonable for this type of contract. Colombia has a policy of measuring the NCI at fair value. Okay, and Colombia company's pension scheme. But pension scheme and all we can read later, right? When we come to that. Now, the first requirement was who is the acquirer and all. Let us go to the requirements again. Whether Colombia should be considered the acquirer or not. So it's not okay, and it's for 9 marks. Then you have to calculate goodwill. Also explaining how the values of both the consideration and net assets have been determined for 11 marks. Okay. First, let us go through the one that whether he should be an acquirer or not. Which standard should you use to know that someone is the acquirer or not? Number one, the keyword is control. It is the control. Control is the word. This is the keyword. Whenever this question is asked, who is the acquirer, whether they can be a subsidiary or not, look out the word for control. And control is explained in which standard? IFRS 10. This shows that you have to make use of IFRS 10. They will not directly tell you like this. IFRS 10 use. No. The question is, who is the acquirer? Is he the acquirer? Colombia, should he be the acquirer or not? So which standard you have to use IFRS 10? Because the main word is whether he has the control over Pero or not. If he has, then he's the acquirer. If he does not, he's not the acquirer. Okay. So in accordance with, so an acquirer is the entity which has assumed control over another entity. That is the meaning of acquirer, right? Give a definition of acquirer, but the word control has to be there. Then, in accordance with IFRS 10, an investor controls an investee where it has all these three things you need to write in your answer. From the textbook only. It should have the power over the investee. It should have the exposure or rise to variable returns from its involvement with the investee and the ability to use its power over the investee. It does not matter whether the acquirer uses that power or not over the investee, but he should have that ability to use his power. Okay, so these three things first you need to mention before immediately saying that he is the acquirer or because these things are there. No, first you need to start like this. Define acquirer, give a standard, then say according to standard what is the meaning of control. Now, so this should be in the first paragraph. Second paragraph, now you're talking about the factors and all, bringing this to the case study, linking everything in the case study. Okay, so there are significant number of factors to consider when determining which entity should be treated as the acquirer. Now you're discussing those number of factors because it's for 9 marks. So it shows that you have to write plenty good number of marks to get the 9 points, not just 2 or 3 points. So you can write each factor in one paragraph. The first factor is discussed in this paragraph. The second factor is explained in the third paragraph. Okay, like that, keep it in different paragraphs. Okay, so what is the first factor? Here the explanations is lengthy, it's big enough, right? But your explanations can be smaller than this. You might explain this in 3 lines or 4 lines, that's fine. As long as you explain and you include all the relevant information, the figure from the scenario, you will get the full marks. Length does not matter. Don't run behind that it's too long, my answers are too short. No, look that in your answer, are the things that has to be included or not? So now what is the first factor? The first factor is to consider the consideration that is transferred for the relevant relative share of ownership. So the first factor is consideration transferred. We are now talking about the consideration. Okay. It may look at first that Colombia and Brazil might have undertaken a joint venture, right? When you look at first, didn't it look that they were taking a joint venture? Even I thought it was a joint venture. Because they told that the two parties share control over the investee. They share control over the investee. That does not mean that they're having joint control. They are having control. Both of them are having control over the investee, but separately. Okay. So you need to bring this in your answer. You have to make the full use of the scenario that is given to you. If you felt like that it's something and it's not, then what you felt before when you saw that, you need to bring this in the answer. For example, in the first instance, we thought it was a joint venture. Sorry, joint control. So joint venture, yes. Okay. So why? Why do you think it's a joint venture again? Another factor. This is because both Colombia and Brazil have paid an equal amount of 8 per share. Remember, they both paid 8 per share. So we thought it's a joint venture because they both paid equal. Additionally, Colombia and Brazil have, and also additionally means in addition to that, both the company have obtained 50% of the equity interest. They have each obtained 50%. So 50% means what? 50-50. Equal voting rights of one vote per share. Okay. So both entities, they satisfy the criteria for rights to a variable return. What is that criteria? Rights for variable return. Now link this. Rights to variable return. It is the second point under this. You need to satisfy this. You need to satisfy this. You need to satisfy this. You have to satisfy all this to show that it's a control. So the second criteria, it satisfied that one. Right? They have that right to get returns from that. Because they have obtained voting power. So through that, they can have the rights to the return, right? Variable return. They don't know exact return, but whatever it is, they have the right because they have the voting power over there, 50%, 50%. So second criteria satisfied. However, a joint venture relies upon there being a joint control over all other key operating and financing decisions of the entity. Please understand this word. Joint venture is not about having equal. It also means that you should have joint control over key operating and financing decision of the entity. That should be done jointly. There the control should be joint control. Not that he has paid it, he also paid it, so both are same, that's why joint venture. Or he has contributed 50%, the other one also 50%, that's why they are joint control. No, they should have a joint control over the decisions, key decisions, operating as well as financing decision. The scenario does not indicate the unanimous consent. That word was not there. I have told you early that when the unanimous consent, this word is not there, it cannot be taken as a joint control. It's not a joint control. So it does not indicate that. So it's required. Okay. It does not indicate that unanimous consent is required because decision making responsibilities appear to be split between Colombia and Brazil. It is split clearly between he knows what he has to do, the Brazil knows what he has to do. They don't have to concern each other. Okay. So that's the first factor. Second factor is to consider who has the right to appoint the majority of the governing board. Okay, so according to the case, Colombia can appoint 60%. Okay, it suggests that he may be the acquirer because 60%. But in case of Brazil, it is true that they does have an additional right in terms of the power to veto amendments, right, to the articles of incorporation and the appointments of auditors. Brazil has that power, that they have the power to veto. They can change the decision. In the assessment of control, it is important to consider whether these rights give Brazil power over the investee. It does not matter whether they have the right or not. What matters is, does those rights give you the power over the investee? If it does not give you the power over the investee, it cannot be said that you are controlling the investee. Okay? So does those rights give power? Having veto decisions and all, having the power to make veto decisions, does it give power over the investee? And whether it can use this power to affect their return. Can they use this power to affect their return also? So in this assessment, it is important to distinguish between substantive rights and protective rights. What are the meanings of this term? Substantive means only rights which are substantive. That means they're big, right? Huge. They have huge rights. Are said to give the investor the control. Very extensive. Not very minor and all. Small amount. No. Substantive. So only those rights which are substantive are said to give investor the control. These rights are more likely to be considered protective, but the rights which he has, they are considered to be more protective in order to protect them. So, okay, protective since they appear to prohibit changes in the activities of the investee. That means you cannot make changes in the activities of the investee in order to prohibit that any changes. Those are known as protective rights, which Brazil does not agree with, rather than give Brazil company power. Okay. So additionally, these are not rights which allow Brazil to affect the profitability of Peru. You cannot affect the profitability of Peru. And subsequently their return also. So protective rights do not prevent Colombia from obtaining control. Coming to the next one. Now we are talking about the appointment of managers, senior managers. So a similar argument can be applied to the appointment of senior managers. Who is appointing them? Who has the power to appoint them? The entity which has the right to appoint the majority of the senior management team. Majority is more likely to be the acquirer. Whereas each entity can appoint one senior manager each. Okay. The rights of the senior management appointed by Brazil appear to be protective. Okay. They appear to be protective while all key decisions are made by the senior manager appointed by Colombia. So it looks like that Colombia is the acquirer because he has all the key decisions. He has appointed all the senior managers who makes the key decisions, right? So the rights of the senior management appointed by the Colombia therefore appear substantive in this case because majority of the decisions are made by them. Including requesting, so what are those? Including requesting board approval for significant activities. They have the rights over decisions affecting the key revenue, earning capabilities of Peru, including technological development. So they can make decisions on which area, technological development. All those things will have affect Peru in their revenue earning capabilities. Okay. Also markets to which they have to operate, ways to raise finance. All these decisions are taken by whom? Colombia. So what can you conclude from this? Does Colombia has power over the investing? Even the first criteria is satisfied. Power the investing. Okay, so the Colombia's power the investing and these rights enable them to affect their return because they have this right. It can change the effect. It can affect their return. So since they have the power, link the first and the third point. The ability to use this power. So they have the power now. They have the ability to use that power also to affect the investor's return. So now it's like you are giving a conclusion. Okay. So further evidence that Colombia is acquired is now what another evidence, some more evidences are there to say that Colombia is acquired. What are they? It's reflected by the share issue which Colombia paid as additional consideration. So to obtain control, it is often the case that the acquirer has to pay a premium on acquisition for the equity interest. And Colombia had in effect had to pay additional consideration to get that control. What is that additional consideration? Shares, right? So it's 50% into 5 into 1 over 20 into 10. Despite each investor acquiring 50% of the equity shares. Even though each person has 50% of equity shares, but when it comes to the control, it is Colombia who has the control. Let us now check how we got 50% into 5 into 1 over 20 and all. So if you see here, 50%, right? Because they have acquired 50% only, and out of that 5 million, okay? And into that, they have to pay and also a 1 for 20 share exchange when the market price of the share was 10. So it would be 1 for 20. So 1 divided by 20 into 10 because the share price was 10. So that's how you are getting it. 50% into 5 into 1 over 20 into 10, which is 1.25 million. Okay. So it can be concluded. Don't forget to give your conclusion. Okay. At the end, it can be concluded that Colombia is the acquirer in a business combination. And that Brazil company in effect is the NCI because this is a 50% accusation. So in 50%, it's hard. It's hard to decide. Usually what happens in normal scenario in the past paper, they tell you that they have acquired 60%, they have acquired 70%. So we know who is the parent, who is the subsidiary. The parent is the acquirer. But in this case, it's 50%, 50%. It's hard. But not all 50%, 50% are joint venture. Like in this question, if you have gone through. So Brazil is the NCI, that one is the this one, even though both are 50-50%. Okay. Coming to the second requirement where we have to calculate goodwill. Okay, and we have to make some adjustments. So keep the inner column for the adjustments, outer column for the final answer. Just. So consideration. How do you calculate goodwill? Normal consideration. You add fair value of NCI minus net assets at acquisitions. Here we have to do a lot of things. Normally they give you the amount of the purchase consideration. They give you the amount of the fair value of NCI and fair value of net assets is given. You just have to put it and calculate. But this one you have to find out net asset. You only have to find the net NCI. You only have to find the consideration. And consideration are two types. One is cash, one is shares. Make sure that you separate out these two. Okay. So when it's cash, it's 5 million into 50% into 8. Okay. And when it comes to share, you don't forget to divide it by 20 because it's 1 for 20 shares. So you have to divide it by 20 into 10. This is the price. Okay. So 20 plus 1, 1.25. When you add this two, it will be 21.25 for the consideration. Coming to the NCI, fair value. So NCI for fair value will be what? It is simply the amount of the cash. Okay, which is 20. So this also you need to add. Coming to the net assets. Per question, net asset is 32. And rest all you have to see below. That means explanation is given below, so you have to find out. So after you add this, this is the net asset, then you deduct and you get goodwill at acquisition as 5.5. Okay, but before getting this, let us see the net assets which is of 32. It is this because in the individual financial statement they had a carrying amount of 32 million. It is this net assets that you have to take. Okay. Now, what is the fair value adjustment? Three things: bond, brand, deferred income. Okay. So we have to see below for the workings. Okay. One is 2.16, brand is 1, and deferred income is 0.59. So we'll keep it for time being and we'll just keep the figure there and we'll write this. We need to use IFRS 13 because they told fair value. Fair value, fair value, fair value, everything. So we need to calculate using which standard? IFRS 13. So fair value per IFRS 13. Now you are giving the definition of fair value. Okay, price paid when which would be received to sell an asset or paid to transfer liability in an orderly transaction between market participants at the measurement date. Okay. Also, this means that fair value is not entity specific. It is a market based measurement. Okay. It is market specific, not entity specific. Okay. So they should take into account, the fair value should take into account the market participants' ability to generate economic benefits by using the asset in its highest and the best use, or by selling it to another market participant who would use the asset in its highest and best use. What about goodwill? You are linking goodwill to the fair value. Goodwill should be measured by deducting the fair value of the identifiable net assets at acquisition from the fair value. Okay. Including any NCI of the consideration paid. So consideration plus NCI minus fair value of net assets. Okay. And that net assets you are calculating should be on goodwill. That NCI you are calculating should be on goodwill. That consideration you are calculating should be at fair value. All these three things should be calculated at fair value. That's why we are using the standard IFRS 13 here. So now let us come to the consideration, fair value of consideration. In terms of the consideration paid by Columbia for the acquisition, the fair value of the cash paid will be equal to the face value, right? Which is 20 million. We have just calculated it because 8 for the share, 50% equity, and into 8 into 5 million. So 20 million, right? The most reliable evidence of fair value is when observable price for an identical asset or liability is traded on an active market. That means when there's an active market. Okay, you can observe the price of the same, similar, identical, exactly same asset or liability. That is the most relevant evidence for using fair value. So the fair value of Columbia's equity should therefore be measured using the market price of their own shares at the acquisition date of 10 per share. So this results in a fair value measurement of 1.25. How? We're taking 50% of the 5 million, that also for 1 for every 20 shares. So you divide by 20 and share price is 10 for share exchange. This is share for share exchange, which is 1.25. Now we are coming to NCI, that should be measured at fair value. So how are you going to measure NCI at fair value? NCI is also measured at fair value and Brazil company paid 8 per share. Brazil is the NCI. So how much he has paid? 8 per share for their 50% equity interest. So this will have a fair value of 20 million, same as your cash, 20 million only. Coming to identifiable net assets, fair value for identifiable net assets. Everything, did you see, they are explained in different paragraphs. Fair value of consideration is in one paragraph, fair value of net asset is in one paragraph, fair value of NCI is in one paragraph. Okay. So in assessing the fair value of identifiable net assets at acquisition, okay, it is important that the net assets of payroll are measured using the same accounting policies of the group. Since Colombia has similar bonds, where the business model is to collect cash flow or to sell, the bond should be measured at the acquisition date, fair values, and treated at fair value through OCI rather than amortized cost. Because the model is to buy or sell. In that case, you should not do it at amortized cost. You have to do it fair value through OCI. So the carrying amount of the bond in the individual financial statements is 6.24 million. How? It was 6 million plus 6 months of 6 million into 8%. See, 6 million we start with the cost, okay? So 6 million, and then we are taking 6 months of 6 into 8%, which is 6.24. Okay, let me take you through that only itself. Just give me a time. Just want to look at the dates. So their year end is 31st December 2005. Okay. And you're finding at 1st of July 2005. Okay, so 6 months. You have acquired this on 1st of Jan 2005. So you have to take before acquisition and after acquisition. After acquisition, only 6 months from July to December. Okay, sorry, you are taking till July. So yeah, 6 months only. Because you have acquired it on July, 1st of July. So from that day, Jan to July, 6 months. So acquired 6 million, 6%. Okay, for 6 million in an unquoted company. Okay, and the effective rate is what, 8%, the premium. So here when you are taking it, you are taking 6 million plus 6 months of 6 million into 8% effective rate. Okay, so now since bonds are an unquoted company and also an active market for an identical asset is not observable in this case. You cannot observe any identical this one. And also it's unquoted. So it's hard to find out an active market for it. It would appear to use the market value for similar asset. You can use the market value for a similar asset, but you need to adjust that as adjusted for differences in their liquidity. So you can use that adjusted one. Okay. So the bond would have a fair value of 8.4. How? This is the amount of the bond into 2 into 70%. And what is that uplift in the fair value of the net assets? Because it would be taken as the net assets also because it is a part of a asset. Financial asset. So 8.4 minus 6.24. So earlier we recorded 6.24 if you see here. From there it has increased to 8.4. So the difference, this will be the uplift in the net asset. 2.16. So this is required. Next is fair value of the brand. But before going to the fair value of the brand, let us go through this part. 6 into 2 into 70%. So if you see here, it's 6 million, okay, and it is sharing at 2 per bond, and also it's a discount at 30%. That's why you are taking at 70% after discount. Okay. Now let us go to the value of the brand. Bond part is over. Okay. Everything is explained in different. So the fair value of the brand has to be determined in accordance with what brand is what? Intangible asset. So this has to be determined in accordance with highest and the best use of market participants. Fair value of the brand, that means still we are using IFRS 13, but this is for intangible asset. Okay. Non-financial asset you can say. So for that we have to use highest and the best used. Since it is not entity specific, the intention, okay, it is not entity specific fair value. Changes based on the market. So whatever the company have the intention, whether to sell, whether to discontinue, it will not have an impact on the fair value. So the intention by this one to discontinue the brand is not relevant unless it is what the other market participants would also do with the brand. If other market participants also starts discontinuing, then otherwise no. So since it is estimated that the company would be prepared to pay 5 million to continue the trade of the trade, this is not the case. Okay. The highest and the best use of the brand from the market perspective would appear to be to continue the trade at a value of 5 million. See, highest and the best use means whether if you are having it, will give you the amount value, or when you or whether after discontinuing it will give you the highest and the best use, the value. So in this case, you are going to get the value if you continue to trade. Okay, so that's why the highest and the best use of the brand is to continue the trade at 5 million. Okay, from the market perspective, this is a 1 million increase is required to the fair value of the brand. How? You need to go to the brand. Okay, because it has a carrying amount of 4 million and it was sold for 5 million. Understanding? Now coming to the deferred income. Brand is also over. Deferred income must be measured from the market's perspective, since the market would expect to incur the direct and incremental cost of 1.7 in performance of the obligation. The fair value should be determined by adding 30% markup to this estimate. So the fair value of the deferred income should be 2.21. How? 1.7 into 130 over 100. You have to add up that markup. So 2.21. Okay. This will result in a decrease in the liabilities at acquisition and therefore an increase in net assets. See, liability decreases means net assets will increase. Okay. Because it is assets minus liability that gives you net assets. So lower the liability, you have to reduce by a lower amount. That means net asset will go up. So therefore an increase in net asset of Pero equal to how much? 590,000. Okay. Let's see how. It's 2.8 minus 2.21. Because if you see here, they have already taken a balance of 2.8 as a deferred income. From this, you have to minus what they have calculated, which is less 2.21. Okay, that means there's a decrease in the liability. Hence 590,000. If you see here, this 1.7 is the cost. Okay. So that's it for the first requirement. Coming to part B, which talks about IAS 19. Okay, just so both the answers you have answered in part A. Now we are coming to part B. I think it's part C actually. Wait. No, it's part B because both the part we have answered of A. Now we are coming to part B. Discuss how defined benefit and defined contribution plan should be accounted for in the year 31st December 2005. For that, we have to read our Exhibit 3. Colombia has for many years, let me zoom out. Okay, Colombia has for many years operated a defined benefit pension scheme. At 1st of January 2005, the value of the pension assets were estimated to be 260. Okay, this is pension assets. And the present value of the pension liabilities was 200 million. The total of the present value of the future advance and the reductions in the future contribution assets ceiling was 20 million. Okay, the table gives the detail where there's a curtailment to the scheme. Curtailment means when employees are reducing, so that will reduce your cost of pension and all. Discount rate on good quality corporate bonds. Okay, 5%. Now coming to this current service cost, cash contribution, benefits, scheme curtailment, payment to employees, and settlement for curtailment. Okay. So 31st December 2005, the fair value of the pension asset were estimated to be 242 and for liabilities 195. They are giving the closing balance. Okay. And the total of the present value of future refunds and reduction in future contribution assets ceiling was 25 million. Columbia intends to all new employees to offer a defined contribution rather than a defined benefit pension scheme. Contributions of 0.5 million were paid into a defined contribution scheme for new employees over the last 3 years of the year. Now, which standard you need to use? IAS 19. So where a defined benefit pension scheme is in surplus, okay, defined benefit pension scheme is in surplus. IAS 19 requires surplus to be measured at the lower of these two things. What is it? Surplus in the plan and present value of the economic benefits in the form of refunds from the plan. That means known as asset ceiling, and the surplus in the plan. The lower of these two things. So at 1st of January 2005, the surplus of the scheme. What is the surplus of the scheme? 260 minus 200. Because asset was 260, liability was 200. Okay. Asset was, yes, asset was 260, pension liability was 200. So that is known as surplus because asset is more than your liabilities, which is 60. But the asset ceiling is only 20 million at 1st of January 2005. Okay, just, yes, it is 20 exactly. I have underlined also. So the defined benefit pension asset would have restricted to 20 million. Lower of the two, no? 60 and 20. Interest on the opening asset would therefore be adjusted. What would be adjusted? Interest on the opening asset. And only 1 million interest income will be recorded in profit and loss for the year. 5% of 20. Because we are taking, what are we taking? The 20 asset ceiling, the lower of it, 20. So on that we have to take 5% because the interest rate, the effective rate 5%. So that is the interest income, right? Now, the cash contributions of 21 million. Where will this go? This should be added to the asset scheme assets, and benefits paid of 25 million are deducted from both the current asset, scheme assets as well as scheme liabilities. And the current service cost of 30 is charged to profit and loss. Basically, you are writing under this where everything should go. Okay. So definitely I didn't go through the figures. Let me go again. Okay. No. ISA 19 states that an entity must first determine any past service cost arising from a gain or loss on a settlement without considering the effect of asset ceiling. So don't take asset ceiling without that. What is your past service cost? That you have to consider. Okay. A gain there arising from a gain or loss on settlement. Okay. So gain therefore should be recognized in profit or loss of Columbia on a settlement equal to 12 million. 28 minus 16. So if you see here, okay, settlement curtailment is 28 and the payment you are making relating to that curtailment is 16. Okay, so on that you have to take 5%. No, I'm sorry, you don't take multiply 5%. We are not taking interest. Okay, we are taking the gain. I'm sorry, we don't take, so it's 12 million. And that pension scheme surplus at 31st December is as follows. You should know this. When it's assets, so you take your assets, you take your liabilities, you take your net asset, net plan asset. This is because asset is more than liabilities. Before adjusting the ceiling, then you take the ceiling adjustments and adjust, and then you get net plan asset after ceiling adjustment. Finally, at the end. Okay. Candidates here are not required to produce this table in its entirety, and the detail provided here is for the tutorial purposes only. They didn't ask you this. If you write it, it's enough. Because whatever you're doing here is explained in writing. So you start with the opening balance of asset 200, you end with 250. This are given, okay? Then we take the 5% net interest on that 260 and 200. We get 30 and 10. Then cash contribution here we have. We need to deduct it from assets. From liabilities, we don't take it. And coming to benefits, it will be deducted from both. Current service costs we deduct it from the liabilities, and then curtailment and settlement we take both. Hence, you take the difference between these two, you will get the net asset. Okay, once you get the net asset, ceiling adjustments. What should be the ceiling adjustments? It's 40 for 1st Jan 2005. Let us go through. Why 40? Because here if you see, surplus of the scheme was 60, okay, but ceiling asset is only 20. So you have to take the difference, 60 minus 20, hence 40. Okay, and then finally you deduct that asset ceiling from the 60 minus 40, 20. So like this you'll get it, and you'll be getting this 24. Now, so the HOD has valued the scheme as a surplus of 47 million. How? 242 minus 195. Immediately after the curtailment, this is after the curtailment they are taking, which would result in a remeasurement loss of 19 million. How 19 million? 66 minus 47. Right? On 31st December 2005. However, let's understand this. Surplus of 47. 242 minus 195. So if you go here, December 31st 2005, this is the asset, this is the liability. So this 242 minus 195. Okay, you take it, which is surplus. That means asset is more at the year end. which is 47 million. And remeasurement loss of 19 million. 66 minus 47 relating to curtailment. Here you have before adjusting the ceiling, which is 66. From here you need to deduct that surplus of 47 million. So here you take and you will be getting a remeasurement loss of 19 because before selling it's more than your surplus, right? Your ceiling, your curtailment. Okay. Net plan asset before this ceiling curtailment is 66 versus this. So it's a remeasurement loss of 19. However, the effect of the asset selling is that the pension scheme would only be recognized as a value of 24 million. Okay. The effect of this one in the pension scheme would that it would only be recognized as a value of 24 million following the curtailment, which is this 24. Okay. After the curtailment, it would be recognized as 24 million. It would be valued as 24 million, the pension scheme. So since the scheme is valued at the lower of the surplus of the scheme and the present value of the economic benefits in form of refund from the plan or reduction in the form of contributions, the scheme will be restated to 25 million because lower of the curtailment and the surplus, whichever is lower. So here the scheme will be restated to 25 million. How it's 25 million? Let's go back. If you see here, net asset, present value of the future refunds and reduction in future contribution asset ceiling was 25 million. Okay. And if you see this is what? Lower of the surplus of the scheme. So if you see the surplus of the scheme, it is 47 and curtailment and this thing, okay, is 25. So lower of it is 25. So that's why we have to recognize it as 25, the scheme. Okay, and it's a gain. So a gain of 1 million will be recognized in other comprehensive income. What is that gain? So that 25 of curtailment that you have recognized minus this 24. Okay, the pension scheme asset would be included in the financial statements at 25 million, lower of 25 and 47. Okay, with a defined contribution. So now we are coming to the defined contribution scheme. Defined benefit plan scheme has been explained in detail. That is always asked. Most of the questions are asked from that area only. But contribution scheme only a small amount. It is the employee who undertakes all of the risk should the pension plan not perform to expectations. Okay, who bears the employee bears the risk. So Columbia would have no obligation further to their contributions into the scheme. It's fixed. They don't have any obligation other than that to make any contribution to the scheme. So this means that provided the correct contributions have been paid into the scheme, if the contributions were correct, then no asset or liability would be recognized within their statement of financial position. When it comes to defined contribution scheme, you do not recognize asset, liability or asset or liability. So the cash contribution of 0.5, this is instead recognized as an expense in profit and loss. That cash contribution of 0.5, which is this 0.5, right? So that's it for question number 1. I have finished question number 1. But before that, one more thing which I need to go. Okay, so that's it. See you in question number 2 of SBR from March, June 2021.